For those that I've met or spoken to before, or should I say not met or not spoken to before, I'm Matt Ostwick. I'm the broker relationship manager. I work in the Southeast market attached to our Croydon and London branch. Also on the call, we have Karen Traxfield, senior construction underwriter. Karen also does property and casualty. Ashley Miller, real estate underwriter, and Michael Rees, motor fleet underwriter. Excuse me. For those of you that attended the recent SME webinar, it's worth repeating. Historically, Zurich haven't traded directly with appointed reps, but we recognise that this is a real important distribution model and is absolutely integral to Movo's strategy and the way they work. I've worked with Jordan and Lee over the last few years to challenge Zurich's approach to appointed reps in an attempt to change our strategy towards this distribution model and the important opportunity it does present to us. We're in the process at the moment of setting up each of you brokers, appointed reps, for direct access to our e-trade suite of products, but this is very much geared around mid-market, and access to Zurich branch underwriters must be channeled through the Movo broking desk. This does present an opportunity for yourselves in terms of accessing Zurich's suite of mid-market products, but also an opportunity for Zurich to do a little bit more in building the account with Movo and their network. So this morning, just in terms of the running order, just want to cover Zurich's performance in terms of the first half of the year and what the second half of the year looks like. Talk about our distribution of products and how you access that. The mid-market appetite, which will be led by Karen, Ashley and Mike, talking about property, casualty, property owners and fleet, talking through some of the unique selling points and key differentiators. And there'll be time for Q&A at the end, but you can either save them up for the end or ask as we go. Just either use the chat, put your hand up, just ask, shout out, whatever, that's absolutely fine. So I'll share the slide deck. Give me 2 seconds. There we go. Can everyone see that okay?
Yes, thank you.
Wonderful. Thanks. Okay, so as I said, this is the kind of running order. Update in H1. We'll talk about the Zurich distribution, then go into the mid-market piece before Q&A at the end. So in terms of the first half of the year, so whilst we're in a closed period in terms of reporting the numbers should be out, I think the latter part of next week. When we look at overall gross written premium, we're up on last year. New business, we're up on last year. Rate, up on last year. Retention, not adversely affected and up on last year. The one area there's a little bit of cause for concern potentially is the bottom line. It's the profitability. We're nervously looking over our shoulder. We still have the claims cost increasing in and around motor and construction and supply chain issues, but we've got to keep a close eye on that. It's all well and good hitting the top line, but we've got to make sure we deliver the bottom line as well. So a really good performance in terms of the first half of the year. Locally, within Croydon and South East, we are propping up the rest of the UK in terms of numbers. Overall, nationally, we're on plan, but we're ahead of plan in the South East. So really, really good. We've worked really, really hard to deliver that set of numbers. And whilst there are resource challenges across the country, our service proposition is stacking up as well. So our brokers are telling us we're doing what we said we'll do through our Net Promoter Score feedback surveys that we send to brokers on interactions they have with Zurich. So we're in a really, really good place. In terms of the focus for the second half of the year, it's very much around mid-market. Now, we sub-segment that by lower mid-market, which is that 5 to 50 million turnover bracket, property casualty-led risks. We then have high mid-market, which sits over and above that. It's the sort of 50 million to 300 million turnover, motor fleet, and also real estate. Especially in this lower mid-market space, we have empowered underwriters. They have tools to trade. We now use Acturis for our quote system rather than using different rating tools as we did in the past. One for EL, PL, MD, BI. We've now just got one single tool to rate with. It's policy documentation, issuance instantaneously. We're a lot slicker and a lot quicker than we've ever been before. So that's all lending itself to the delivery we've seen in the first half of the year. In terms of our distribution, it's worth just reminding you guys, SME or E-Trade. This is for customer turnover under 5 million or small fleets from 2 to 20 vehicles. This is all via e-trade through Acturis Open Market. As I said at the start of the call, we're in the process of setting up the appointed reps to be given direct access to e-trade. Referrals, however, still need to be channeled in through the Movo broking desk. For the purposes of this and mid-market, again, mid-market inquiries need to be channeled through Inshan and Tiana on the broking desk. The lower mid-market customer turnover 5 to 50 million, high mid-market 50 to 300 million, fleets 21 vehicles plus, and construction the same, so that 5 million plus bracket. From a real estate or property owner's perspective, typically, Ashley would get involved where the declared value is in excess of 5 million. Anything smaller can be placed via E-Trade. And we also have a mini global team up in Birmingham as well for UK domicile customers that have overseas exposures. So again, just to reiterate the point, all new business presentations need to come via the Movo broking desk into us, and there's the inbox that needs to be sent to for our login process to work. But also feel free to copy me into any of those presentations. Karen, if I can pass over to you from a mid-market property casualty perspective, just let me know when you want me to move on.
Yeah, move on. Thanks, Matt. So my name's Karen Chaxfield. I've worked at Zurich for about 7.5 years now. Recently promoted to the senior underwriter, looking at construction and property and casualty. I quite like doing the variety of the work in both of those, and sometimes I can package them up myself anyway. But I just wanted to have a chat with you. So around appetite, it's always quite difficult with appetite because we can have a risk that might be on the edge of appetite, but it's run really well. Their health and safety is really tight, and there can also be there's a green trade and it's not so, and then we wouldn't want it. So the only risks that we can't really write are motor trade and waste and recycling. Anything else we can have a look at, but like I said, we could say that we write restaurants, but if one's in London and we're struggling with exposure, then we're not going to be able to do it. But potentially we can look at anything other than waste and recycling and motor trade. All the ones that are on this slide, the manufacturing, wholesale, retail, sports, leisure and entertainment, food and beverage, professional and business services, I'd like to be able to sort of say we're winning particularly in any of them, but to be honest, we're winning at all of them. We've got a great strategy at the moment. The lower mid-market, which is the 5 to 50 million, is our sweet spot. And so we can be price aggressive for the right risks, which we like on our team because it helps with our targets as well. But basically, if it makes money and we feel that that's the right price for that risk, then we can do it regardless of what our technical price is. And I know some other insurers have got a bit of a bad name for buying the risk in really cheaply, and then at first renewal they'll hike the rate up. That's not what we're doing. We're trying to keep it a consistent rate. But thanks, Matt. The next one. I won't go over these because otherwise you'll have death by PowerPoint, but it just outlines some of the manufacturing trades that we see come over. So it could be anything really. The only thing we wouldn't do is like aircraft parts. They're sort of excluded, but then we see a lot of presentations come over from, and the actual products are on a separate aviation policy. So then we're fine. To us, it's then just really probably a metal risk. But yeah, so just shows you some of the stuff that we've got some the bigger football stadiums. I know particularly the men like having a look at them, especially if they need to go on a survey, but they're quite interesting to look at. And from a construction point of view as well, we've had quite a few, probably more so lately, where the season's finished and teams have been promoted and then they have to come up to like Premier standards. So we've had quite a lot of projects come through for football stadiums that we insure, and they're having new underground heating or they've got to do something to the stand. But I mean, in general at the moment, just to sort of go on about our construction strategy, we are still quoting, we are still open for business. However, the book is a little bit vulnerable at the moment because we've been hit with some large liquidations, which I think is probably nationwide. We've also been hit with some large losses, particularly working at height. So that's something that we're really focusing on at the moment, not just on construction, that's on property and casualty as well. We're sort of drilling down into the working at height. the claims, I think what's happened is they haven't been settled as quickly as we would like, so those claims costs are going up. So we're taking corrective action now so that we don't have to take more corrective action later on. So we're just trying to sort of balance the book a bit. So although we are open for business, we can't flex on our rates, and we're being really risk selective on the annuals that we're taking on. Standalone projects with no connection have always been a decline since I've worked at Zurich, but we've got such a massive real estate book in London. If there's a connection with the real estate, or we hold the contractor's annual, we will look at the projects. But mostly at the moment, it's just our green trades, the new house builders, the allied trades, shop fitters, that type of thing. Thanks, Matt. If you've got a client, though, that is looking for more on the product rather than so much of a price, I always say that our construction product is probably the Waitrose, Marks and Spencers of the insurance world. It's a fantastic product. If anyone wants me to send over the details of it, please let me know, and I'll be quite happy to send them over with the summary. But it is market leading. It is a really good product. So if someone's looking for more cover rather than so much of a price, then let me know and I'll send it over to you. But they're some of our superior proposition, as Mr. Roswick so greatly put it. Thanks, Matt.
Thanks, Karen. Any questions for Karen around the property casualty or the construction side of things? If not, we'll move on into fleet. Over to you, Mike.
Thank you, Matt. And yeah, my one does have a lot less slides, which I'm thankful for, with the fleet being a little more simple on my behalf. Similarly to Karen, to be fair, in terms of the appetite, there's few things we can't write, and they're fairly similar to what Karen mentioned, to be fair, in terms of the motor trade, waste, self-drive hire, blue lights, etc. Everything else for the right risk we can consider. Those ones which are the more heavy fringe trades, amber trades, however to put it, those are the ones which you want to see, well-run risk management. Just as an example of one that was won recently, which sort of fits into this, you had a Japanese food wholesaler based sort of central-ish London. So obviously, yeah, on the road the whole time, built up areas, a trade where you want to see it. They're always going to have a decent amount of claims, just due to the nature of where they are and what they do. So it's all about mitigating the chance of large losses and consistent incidents, and they had a very good risk management culture there. This one we're setting up a post-bind survey on, just so we can assist the client going forwards and work with them to consistently mitigate their claims. So it's one of those ones which we're not looking to completely fill the books up with, but for the right ones we can definitely come in aggressively and pick up the right cases. Our USPs, we have a few which generally do help us secure quite a few clients, which is often the any driver basis for the vehicles, and the no increased excess for the young drivers. That's quite a lot of clients are very keen on that element. Interest-free installments, which again, I don't know of many other insurers that are currently still offering this, to be fair. It will just depend on our sort of internal credit check score, whether or not we are looking to offer that. We can pop to the next slide, please, Matt. Yes, just to touch back on, the risk management proposition. We've got a few partner suppliers. I can send over some marketing information regarding this. We're partnered with a few providers. We've got a whole team, the ZRS team, which can also offer their own services. That second little point there, it's not anything too in detail, but it's something you can send to clients to do a quick, maybe a 30-question set. Just as a quick check to spot check if they're doing anything notably wrong, and it will give them a few pointers and answers based upon the questions they give. That last point sort of ties back in really with what I was mentioning about some of the larger cases. When they are more complex ones, we like to get in a good lead-in time, get one of our surveyors out to give sort of a tailored proposition to try and make ourselves comfortable, understand the risk, and again just work with yourselves and the customer going forwards, really.
I think that point, sorry, Mike, to cut across you. I think that point is relevant, not just for fleet, but property casualty, construction, property owners as well. Having that right lead-in time is crucial for us in terms of delivering the right proposition for you and for the customer. If something comes in a week or so before renewal, yeah, we could put a price on it, but will it be our best price? Will it be our best proposition? No. Having that lead-in time, and we're typically talking 30 days or more, allows us to formulate the right proposition for your customer. So the lead-in times are crucial. Where time allows, of course. I know it's not always easy and you don't always get that, but where you can give us that time, it works a lot better.
Yeah, absolutely. I got a good point, man. I mean, it's not always possible, but even if the full information isn't there, just an early conversation really with, so for example, on the motor, just vehicle list, claims list, and we can just have an early chat effectively and get the wheels in motion earlier. And yeah, I think as mentioned earlier as well, the increased claims costs at the moment. I mean, the fleet market there's a lot of fairly poorly performing risks this year in terms of a variety of reasons. But again, that's another reason why we're looking to do as much as we can to make sure what we onboard are doing the right things, just so as we're not completely adversely affecting our book, as Matt mentioned with the profitability earlier. So we are placing a lot of importance in asking these questions and looking to work with the customers. Back to the EVs quickly. We are happy to accommodate in general full fleets worth of electric vehicles. I know lots are looking to switch to more electric vans. Heavier electric trucks, yes, we can accept. I know they're pretty expensive a lot of the time, so they may well come with additional terms on them, as could be expected. But yeah, we are more than happy to accommodate all electric vehicles. Just to quickly touch on, again, this is nothing that you wouldn't be expecting, but on vehicle types. Just saw a question come in there, which I'll quickly answer. I should have mentioned that one on there. Courier fleets is not an appetite for us, to be honest. We stopped a few years ago, I believe. We did used to have a few. I don't think we have any legacy ones left over anymore, to be honest. Just on vehicle types, Range Rovers, I guess the rest of the market will likely be the same with us, particularly with privately owned ones, with all the theft issues they're having. We're don't particularly have an appetite to onboard, well, many, if any, sort of particularly expensive Range Rovers. If we do, they won't be cheap. We'll need a lot of security risk information and be applying large excesses. But again, that's something which I'm sure all insurers are doing currently.
Thanks, Mike.
Well,
any other questions for Michael on the fleet side? We should move on. Ash.
Afternoon. Morning, sorry, I should say. So my name's Ashley. I've been working at Zurich now for nearly 2 years. Previous to that, I was a broking account handler for a large broker, Arthur J. Gallagher, and I've worked at various MGAs, people like that, for the last 10 years of my insurance life. So I predominantly deal with the real estate property owners book for new business. If you go next slide, please, Matt. So yeah, some of our appetite is basically pretty much what the rest of the market are doing. We like residential stuff, which is professionally managed, concrete floored, good claims history, things like that, pretty much vanilla risks. Some of the things that we struggle to write are grade listed properties. Grade 2 listed, we can take a view on if it's part of a larger portfolio, but on their own, in isolation, it wouldn't be something that we'd be able to offer terms on. Warehouse risks, depending on what the trade is in the warehouse, if it's just for storage and things, that wouldn't be something that's within our appetite, but we can take a view on it if it is connected to maybe a P&C case that you want to obviously place. We can look at a package and maybe offer some terms that way. We do price ourselves sustainably, so we're not the kind of company that are going to buy things in extremely cheap, like I know Aviva, AXA and Allianz are all doing at the moment, and then put a 20-30% rate increase on at next renewal. We price ourselves, like I said, sustainably, so providing there's been a decent claims history, no claims in that year, you're probably looking at maybe a 10 to 15% rate increase on obviously last year. So if you are looking, if price is important to the clients and you want to get something that's dirt cheap, we're probably not the best when it comes to it. Although we can be flexible with our rates, we're not as flexible as the P&C guys are, because obviously real estate, it's a much more difficult market where appetite, and there's obviously a lot large losses with escape of water problems, storm, flooding, things like that. So a few little details there regarding what we like and what we don't like. We can take a view on most things. So if you think there's something we can do or you want to put to us, the worst I can say is no at the end of the day. Again, like P&C, things we don't like are like motor trade, waste recycling, listed properties like I mentioned, and warehouses in isolation. But anything else we can really, I've been getting a lot of success at the moment with shops with flats above, so that might be takeaways or just general supermarkets, things like that. Purpose-built residential, I've been getting a lot of success on there as well. Next slide, please, Matt, if there's anything else.
No, that's it.
I don't think there isn't, is there? No,
what about the distribution, Ash? So where it's under, I mentioned at the start, anything under a declared value of 5 million technically is E-Trade.
Mm-hmm. I can take a view on that. I mean, there are certain things which will be declines for SME. For example, if it's got more than, I think it's 35% flat roof, SME will decline that. That's not a decline for Zurich. If it doesn't fit on our SME platform, providing we're not getting hundreds and hundreds sent in every week or every month, I can take a view and we can write it. We're not going to have the SME rates because obviously we're open market and our policy wording is a lot more enhanced than an SME policy wording would be. But if there's something that you're looking to place, it doesn't fit the SME, do send it over and I can have a look at it for you. I know takeaways with deep fat frying are decline. We can write them in, obviously, in branch, and flat roofs, like I said, they'll decline anything over 35%. Send it over to me and I will be able to have a look at it on your behalf.
Thanks, Ash.
No problem.
And unbelievably, after 25 minutes, that takes us into Q&A. Anything anyone wants to flag up? Any questions? Any more information you want to know from the underwriters or from myself? What I do, so I'm recording the call, so I'll get it clipped and I'll share it with Jordan to communicate and cascade. I'll also attach the presentation that Jordan can cascade as well, so you can refer back to that should you need. Look, if you want to have a conversation with me, I'm comfortable with that. If you want to pick up the phone and talk to me about a risk, I'm comfortable with that. But as I said at the start, the distribution and the way we're distributing the product to you as brokers of Movo is through the Movo broking desk. I appreciate it adds another chain into it, but that's kind of where we are at the moment. That's the process and that's how it should work. But as I say, if you want to have a conversation with me, feel free to pick up the phone. I'm happy to chat to you. Cool. So we'll leave it there. Thank you for joining. Thanks to Ash, Mike, Karen as well. As I say, pick up the phone, talk to me. I'll get this all cascaded out through Jordan and look forward to receiving your inquiries. Cheers all. Thank you.
Thank you. Cheers. Bye.
Thank you.
Bye.